Welcome back to Stockwatch, or rather welcome to Stockwatch with me, Ntauleng Lechela. And joining me to unpack your stock-related questions today are Mark Du Toit from Oyster Investments and Grant Nader from Benguela Global Fund Managers. Be sure to send your questions through to us via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Gents, thank you so much for joining us this evening. Perhaps let's start with a general markets action where we have geopolitics still in focus, and market reaction has been quite interesting. I mean, I think it was on Tuesday we saw a bloodbath. Wednesday it seemed like markets were recovering, but hey, we're back in negative territory today with precious metal prices easing yet again. How have you been making sense of it all, and how investors are reacting to the potential fallout when it comes to energy prices, and how that is stoking inflation fears, Grant?
Hi guys. So for me, the key point here is how long do these oil prices stay elevated, and also how high do they go? And I think that's what investors are trying to digest. And you know, we've seen oil, it's up about 16-17% over a week. If it's back to where it was 2-3 weeks from now, you know, no harm, no foul, and the world will move on. But if it's still here and it's ticking higher even in the next 2-3 months, 4 months, this starts to now impact global growth. It starts to impact inflation. It starts to change the rate cutting outlook.
Yep.
And so there's a lot of knock-on effects if you don't, you know, you can try and look through this, but if you look through it and it doesn't pass as quickly as you're pricing, there's actually second and third order effects that the people are trying to weigh up this effect. So if you think about the PGMs, highly dependent on global growth, vehicle sales, etc. And the longer these issues remain, you're going to start seeing that premium coming out of those prices. So it's not yet clear how quickly this passes. There's blockages in the Strait of Hormuz, which everyone's talking about. There's also risk to the refineries and the production in the region. So for investors, it's about how quickly do you put your toe back in the water, take advantage of these opportunities, and perhaps maybe you get ahead of yourself, and then you could be facing a much different global growth outlook, and then the story changes again. So that's just on a global level. Obviously, in SA, it's even more directly affected by the rand oil price, inflation,
Yes.
etc., etc. So I could go on for a period of time, but I'll give Mark a turn too. I think the key point is, how big is the splash zone? So does the regional conflict expand into multiple countries, or does it stay contained? And how big and how prolonged is the impact on oil prices? And those are the most important questions to answer right now.
Yeah, and no one has the answers at the moment, but we do know that President Trump said that it might last for weeks. Whether that's 5 weeks, whether that's 8 weeks, we just don't know. Mark, let's bring you into the conversation. I touched on those inflationary concerns being back on the table on the back of what we are seeing in energy markets. Alongside that, we also got some labor data out of the U.S. The private sector jobs looking good. Considering that backdrop, does it change your outlook for U.S. monetary policy? We've heard from some traders pushing back or pulling back on their rate cut expectations. Is it too soon to start dialing back, considering that we're all at a point where uncertainty really just remains the name of the game?
Yes, well, that is exactly the point. I mean, I guess the data that we saw out of the US is backward looking, and since the weekend, the world is a different place now. Certainly, the inflationary fears of higher oil prices is what's driving that reduction in the outlook on the interest rate cuts. And there's a lot of anxiety around the Strait of Hormuz. 35 ships or oil tankers pass through there every day, and at the moment, one or two are trying to get through each day. And that creates a serious logistical issue for the oil market. 20% of the seaborne oil market comes through that strait, goes mainly to India, China, and Japan. But even so, it's not an isolated impact, because those countries will be impacted and then it spills over into the rest of the energy market. And that's why we've seen like big moves in energy stocks like Sasol, like Benguela, all related to high oil prices and the anxiety around about how long the strait is going to be closed for.
And I'll pose a question to you as well then, Grant. Are we getting ahead of ourselves here? I mean, I was reading through some commentary earlier this week, and some analysts are throwing the term rate hikes when it comes to the SARB even. I'm just shocked at this point.
Look, yeah, I think it's premature to say we should expect rate hikes.
Yeah.
But what I probably can say is if the rand is still where it is or weakening further, and oil is still where it is and weakening further, so oil's up 25+% this year, the rand is now weakened 3, 4, 5%, and you roll forward 3 to 4 to 5 months, you start seeing that feed through into our inflation numbers. We know we have a hawkish Reserve Bank. We know they're targeting 3%. 3% is going to be less and less likely with every day that passes. So while I wouldn't say there's a rate hiking on the table yet, I would certainly push those rate cut expectations out very quickly if we see this persist.
And I mean, that mirrors some of the commentary from Governor Lesetja Kganyago at the last meeting in January, where he outlined scenarios on when oil price goes higher and the rand weakens. We would probably see the bank then push back those rate cuts. But talking about rate cuts, perhaps let's look at some company news out today. FirstRand, right, posting record profit with HIPS up about 11%. It's SA Ops faring well, but of course the UK vehicle finance issue remains an overhang. Let's just get your analysis on those numbers, Mark.
Yeah, I mean, really encouraging numbers. I think that the number that they printed today was good. What still is an unknown is what kind of provision they still need to raise.
Yes.
And we will get some clarity. The FCA in the UK said that they will present this later this month, so we will get some more news on that. I think what FirstRand also mentioned is that they've got another private equity realization to come, and they've been very good over the years at matching the private equity realizations to cover up any kind of sort of miss on the earnings side. So if they need to raise a provision, they'll realize some of the private equity profits, and then just kind of smooth over the earnings. So I mean, and I think that the market will really take a lot of comfort in that once the issue's kind of out the way and known. They also have a provision already, and they put through some expenses through the income statement relating to their legal costs. And once the finding is released, they can start putting some costs against their provision as well. So that will also help with on the earnings side.
So the UK
I think that
yes.
Yeah, sorry, just to say that I think the outlook was very positive as well. But given what's happening in Iran, that's now clouding the issue in the shorter term.
I mean, I was talking to Mary Vilagazi earlier today, and she did mention that they are watching it quite closely, but also mirroring those comments out from Lesetja Kganyago, the governor, of course, saying that the higher oil price will likely just push back those rate cut expectations, or rather the rate cutting cycle over here at home. Let's get your thoughts around FirstRand's numbers. What I found quite interesting is the African operations, right? We are seeing a bit of a mixed picture on that front, Grant, where Botswana and Mozambique are struggling, but they are faring better over in West Africa.
Yeah, look, the African operations for me are still fairly small, and they're a distant second to Standard Bank in terms of driving earnings out of Africa and growth, and then second Absa, and then only FirstRand. But it is a growth area, and they are looking there, and they're trying to build up their presence. I mean, West Africa has been good for the other banks as well, and they're going to be a beneficiary in general of this commodity uplift that we've seen. So I think it makes sense to me that that those regions are doing well. Botswana, we know, is hurting from the diamonds, the diamond prices. And for FirstRand, I think they need to bulk up their presence in the space to really move the needle. In the absence of that, they still did a great job. They did healthy ROEs. They remain a top management team. So yeah, I think nothing unexpected in where they're delivering in Africa from where I sit.
And in terms of scale, granted, just to get your thoughts around that, how do you think they can, I guess, benefit or further penetrate the African market? There's been talk around perhaps partnering with fintechs and not necessarily getting a banking license.
Yeah, certainly fintech seems to be the order of the day. Everyone wants to move into the fintech space, and I think it's an obvious place to see where the next layer of growth is. You move down the income spectrum and you play in that space. Maybe not as easy as it looks. There have been a number of the international banks like Stan Chartered, exiting regional offices in Africa. That's been an opportunity for some of the banks. I think Standard Bank picked up one of those businesses in Kenya, but the risk is overpaying, and FirstRand's quite disciplined about what they pay. So I think the fintech space does seem to be a good opportunity. I think the growth in Africa, the adoption of new technologies around money is very high. So it is the obvious lever to pull. I don't know how easy it's going to be to get scale though. Once again, given the size of FirstRand, but it would make sense to see them move that way.
Perhaps let's zoom in further on the quality of the banking earnings then, Mark, and put up Nedbank's numbers that we also got out earlier this week.
Yes, so Nedbank also came out with better than expected numbers. The expectation was that they would have flat earnings and actually came out with a 2% increase. They've also gone through quite a big, I don't want to call it a transformation, but they sold out their stake in the ETI business, which was their African banking business, because they didn't want to be a minority shareholder anymore. And then they made an offer for NCBA, which is mostly a Kenyan banking business. So that deal will close late in the year. So a bit of moving parts in their numbers. Their cost control was better than expected. And I think, we saw the share price up on the day that they put their trading statement out. So I think that they're also one of the smaller banks, and there's always this question as to whether they have enough scale. They have a higher cost to income ratio than the other large banks, but they really are kind of chipping away and doing the right thing. So it'll be interesting to see how the Kenya acquisition pans out for them, and also showing that South Africa's in a better space. The credit loss ratios are lower, also good outlook, notwithstanding this weekend's events. But so I think a good result for Nedbank.
And just on all those moving parts, I think it was Jason Quinn, the CEO of Nedbank, that described it as a transitional period. So let's get straight back into it, kicking things off with the education sector. We got numbers, or updates rather, out from Stadio and Advitech. Which of the two stand out for you there? We did see both companies forecasting a double-digit earnings growth. Of course, they are somewhat different, with Advitech operating in both schools and the tertiary side of things, whereas Stadio is just in the tertiary sector there, Grant.
First of all, I think they are both very good businesses with good management. They're playing in a great space. There's structural growth, so I think they're both good. My pick has been, of the two, I prefer Stadio, just because I like their focus niche. But Advitech is a high quality business. We actually hold some, and we still like it even here. We've just had a look at some of their new campuses. We've done the site visits, and it's very impressive. I think the private university opening that's now being provided to these guys is giving them another leg of growth, to accelerate their growth and their offering. And I think these are like long-term, structurally growing businesses that in SA, we all know the need for education and the shortage of supply. So they're in a good place, and they're operating well. Both very good businesses. You can own both. That's my view.
All right. What about you then, Mark? The share, what's this? The graph for Stadio was up, and that counter closed the day 8% higher. Just your read through those updates, looking at the earnings growth as well. Stadio coming out tops, forecasting earnings of about 27%. I think Advitech was forecasting growth in the late teens.
Yes, I mean, both nice results. I think that the earnings numbers were fairly much expected, although judging by the share price reaction in Stadia, maybe a bit of a beat there. Yeah, I mean, and then you do pay a higher multiple for Stadia because you are paying for the growth. You pay a slightly lower multiple for Advotech. But yeah, I think both businesses will do well. Yeah, I mean, I like the expansion opportunity that Advotech has into Africa. They've been quite successful since they slowed down a little bit a few years back, and now a bit more deliberate about their strategy. And shouldn't certainly large demand for quality education. They offer the Cambridge curriculum, and yeah, I think both will continue to do well.
All right, let's take a look at some other questions coming through, starting with We Buy Cars. Mark, would the panel consider the stock attractive or offering value if it were trading below 40 Rand a share?
Yeah, I mean, I think that actually picked We Buy Cars on Stockwatch a few weeks ago. So yes, we like the business. I think it has come under pressure from I mean, the rise in the Chinese car sales in South Africa, the slowdown and maybe the replacement cycle. But these are sort of shorter term issues, and I think longer term the business will do very well. They continue to expand, they continue to take market share. Yeah, and I think at this price, it's a good entry point. Short term, we could have a bit of volatility in the SA macro space, but longer term, I think We Buy Cars will do well.
So short-term volatility, but is it a hold in the long term, especially as we are, of course, seeing structural shifts within the vehicle market, just reflecting on numbers out from Motors, numbers out from Super Group. Both counters, of course, have exposure to that new vehicle sales market doing pretty good. Grant.
Yes, yeah, absolutely. I agree with Mark. I think it's a good business. They've got an excellent sort of scale. They are the leading in the space. And I think this Chinese car, this compression of pricing is going to hurt them for a little bit longer than we initially would have thought. I think that growth of Chinese vehicles is still a long way from done. So the new car sales are going to continue to be in place of second-hand cars, maybe for another year or two. I'm not sure quite how long. But what I will say is if you look through that and you're not trying to time it, I think this is one to hold for the long term. You just have to maybe be a little more patient than you would have hoped at the start.
So this could be a good entry point, basically.
Yeah, I think this is a good level. Definitely, I think it's a good level. You can buy it here in the low 40s, but my feeling is that you need to be patient on it. Yeah, that's before that those new cars filter into the second-hand market and start to circulate more, on a high level.
Talking about good entry points, then we have seen a pullback in precious metal prices. Implats in particular closed 7% lower despite delivering such, bumper results. Grant, is this an opportunity to perhaps buy the dip when it comes to some of those precious metal counters?
It's a good question. I mean, it's not much of a dip in the context of the move we've seen over the last year and a half. However, if PGM, it's actually unfortunately contingent on what happens at the start of our show, which was all about oil and inflation and global growth. If you think we're going to move through this issue in the Middle East reasonably within the next month or two, you probably can buy the dip in these PGMs. If it starts to become more structural, starts to impact global growth, I think the dip has still got further to go. Yeah. What I will also say is I don't think Implats actually put the best set of results forward out of the bunch. I think Valterra seemed to me and Northam actually were the pick of the lot.
All right, let's get your sense then around those platinum players. Mark, we got numbers out of Impala Platinum. As Grant mentioned there, he thinks that numbers out of Valterra, numbers out of Northam were better than the numbers we got today.
Yeah, I mean, I think that, Implats put out decent numbers. The production was slightly ahead, which is always what you worry about in a mining company, is if they're going to make their guidance, no hiccups in their production. Their costs were higher, but I mean, we've been seeing that coming out of all the mining stocks. It was only really Valterra that had really great cost control.
Yeah.
I think the market was a bit disappointed that they decided to sit on quite a bit of cash. I mean, it is an interim reporting period, so you wouldn't typically declare a big special dividend in an interim period. So maybe a little bit harshly punished by the market for doing that. Yeah, but I mean, it's a solid operation. I think the one thing that they do miss a little bit in terms of the PGM counters that we have to choose from is that they don't have a lot of growth in their portfolio. Valterra's got a lot of growth should they wish to turn it on in their Mogalakwena project. Um, and yeah, Northam's got a bit of extra growth that they can kind of squeeze out in the next couple of years. So I think if you have to pick between the three, I mean, our preference is still Valterra, but yeah, all dependent on PGM prices going up in the medium term.
Considering that these miners are in a sweet spot, then, Mark, when it comes to cash, do you expect then a player like, I guess, Impala Platinum to perhaps invest into the company when it comes to, extending mines' lives, etc., etc.? Just chatting to Nico Muller, he also, like Paul Dunn, expects this cycle to continue in the medium to long term.
Yeah, I think that I mean they all put up slides in the last week or so about there being deficits in the market in the medium term. Um, that is contingent on world economic growth holding up and car sales continuing to be strong. If there is a downturn, that deficit forecast will turn out to be incorrect. But while they're making good cash, we will see them start to reinvest more in their businesses. We'll definitely see more life extension projects. All the mining stocks have got projects that they want to do, but they ultimately have to weigh up your returns, your expected returns in the future. And at high prices, you get to do the projects that you've always wanted to do. So I think we will start to see more and more of. We saw quite a lot of the mining projects coming out of Pan put forward a lot of projects that they want to do. Anglo Gold put forward some projects. So yeah, we'll continue to see that if the prices hold up. And really for South Africa, it's great for our economy because we produce 95% of the world's platinum, and I think almost all the rhodium. So yeah, long may it last.
All right, let's then get into your stock picks. Where are you seeing value at the moment, Grant?
So my pick is Discovery. As you know, they delivered results, strong set of results yesterday. It's not my first time I've picked it, but what I liked is that you're starting to see things come through that was part of the reason to own it. So you've seen the bank swing to profitability with continuing profit growth baked in there, and then you have the added benefit of the UK starting to contribute meaningfully to the earnings. And for some number of years, the UK was really an underperformer. So that life and vitality contribution out of the UK really kicking into gear as well. I think they've got limited cash requirements for investment, which they've continuously reinvested in the past, and they're now sort of reining that in. You're starting to see the cash flow kick in. The growth prospects are pretty good. There's not a lot of growth in SA, and this is one of those that has a genuine organic growth path in front of it. So I think they're doing all the right things. Yes, the shares had a bit of a run, but I think if you're taking a 2 to 3 year view or 4 year view, you can still own it here. So that's my pick. It's Discovery. What
about you then, Mark? What are you hanging your hat on this evening?
Yes, I'm picking Anheuser-Busch tonight. Just in the context of we are worried that the Strait of Hormuz is going to be closed for longer than what we all hope. These global conflicts tend to take longer to resolve than you initially hope. So I'm looking for something with a good defensive stock that can benefit from a weaker rand. So Anheuser-Busch fits that bill. We think that the volumes have now started to increase. The next set of results will show volume growth. 25% of their business is in America. Should the Soccer World Cup go ahead as planned, it'll be helpful for their beer sales. They continue to make a lot of great free cash flow. They're paying down debts. They've got a share buyback program in place. And they are quite far removed from the issues that are being experienced in the Middle East at the moment. So my pick is Anheuser-Busch Clyde.
AB InBev for Mark and Discovery for Grant. Gents, thank you so much for your time and joining us this evening. That's all for Stockwatch today. Thanks to my guests, Mark Du Toit from Oyster Investments and Grant Nader from Benguela Global Fund Managers. Up next, The Close.